All right, check, radio check. I want to thank everybody for taking time out of your busy schedules to hop on our weekly chat with Chris. And hope all is well. Before we get started, like we normally do, if somebody wouldn't mind typing into chat that you can hear me and that you can see my screen, we'll go ahead and get started. There we go. And thank you, David. Thank you, Kate. All right. So, if you've not been on this call before, or if you're on live stream watching from your office, typically we started doing these when COVID started, 2020, I guess, is really when it took off, and we've been doing it since then. And it's just we try and be consistent and bring topics that are current, relevant, and sort of our interpretation of what we see. Now, once a month, we do a rear view mirror of what we've seen in the markets, right? So, quite often we look at the data today and it's so overwhelming. We get lost in the bigger picture, and are we going in the right direction, and should we make any course corrections? So the purpose of these calls is to really just sort of make more of a thoughtful analysis of what's going on, and less fear or greed, which is typically what the media would have you buy into. That's what keeps them running. So before we get started, though, September, we're coming to the end. This will be the last Thursday in September. You may recall September is Life Insurance Awareness Month. And I'm not going to read this whole thing to you, but there are two areas here that, in January 2024, 51% of consumers reported owning life insurance, individual, employer sponsor, et cetera, which is down significantly from 63% in 2011, right? So that's the first component. But then when you find out why, the number one reason consumers give for not purchasing life insurance or more of it, it's just that it's too expensive. And really, I think folks are either misinterpreting or not really understanding the need, the value, the benefit of properly structured life insurance. It really is a very powerful tool. You've heard me say before in the past, I personally feel that life insurance, cash value life insurance, not term, because term is a commodity. It's something where you can go on, and then all of a sudden I have a client right now that's I just had a open heart surgery. He's coming to the end of their 15-year term. He's relatively young. He's, I think 59, 60, and, but had open heart surgery. And now the term was going up to an unaffordable amount. And now he finds himself in a position of, well, he still had a mortgage, couldn't, and the premiums are astronomical. And to even get him something close to reasonable is now it's too expensive. So that's where the risk is most people face when they buy the cheapest thing or buy it purely as an expense, versus part of what we've taught our clients over the years is owning life insurance as an asset class. So, if you've not reviewed your policy recently, if you've bought life insurance in the past, you think you're covered, there's no harm in getting a second opinion and seeing that, can you upgrade what you currently have? So we're happy to help in that area, but I wanted to throw that out there because in the spirit of, once a year, we do a hard push on life insurance, just from an awareness perspective, and making sure people, are checking and pulling it out of their drawers, dusting it off, and seeing if it's, current, and if any adjustments need to be made. Now on to our monthly topic, which is, we do a monthly rear view mirror approach. So what's going on in the markets? Well, again, even though we call this a September monthly update, this is actually looking at August. And when we look at 1 month of equities, right, and the different indices, so you have the Dow, then you have the Russell 2000. That actually had a negative month, which is small businesses, small caps. Then you have Europe, right? So that actually did well. And then you had real estate at 5.22%. So, although we have a squiggly line here like we do every month, and it looks like spaghetti, and you're trying to interpret the data, I don't put a lot of emphasis on a 1 month snapshot. We are now 8 months, at the end of 8 months, this data looks like this. So this was to me, and I was thinking back is to the beginning of 2024, and in the first Q4 or Q1 of this year, I was saying, hey, let's be cautious around election time. But up until now, you know, and again, this is why you can't time the market. You need to be in the market, you need to be in the market thoughtfully, and you need to be diversified. But the green is the S&P has done almost 19% this year. We had, you can see that spike down in the beginning of August, and with everything that's going on in Israel and Hamas and Hezbollah and the Middle East and Ukraine and Russia and China. I mean, it is not surprising that we have some challenges here. But the markets are robust, and the Fed just cut last week, and you're going to see that now, interest rates. So the economy is shrugging off some of the concern. And equities, which should be a strong portion of your portfolio, diversified amongst these different asset classes. You see that you had the S&P at 19%, and then you have the Europe at 12. Purple is the Dow, and then you have small caps. So you have the top four are three out of the four are US. So the US economy is strong, it's healthy, looks good. However, this snapshot, if you took all that data and you go, okay, I'm good, I don't have to worry about anything. Now let's look at one of the areas that I mentioned last time, is that we have a red line, right? So this is a technical indicator. It's what we call triple cross, or the three wise men. And there are three indicators: the RSI, which is the relative strength index, which really just measures the speed as to how quickly things are starting to change. So we had a crossover, right? And three of these have to have been flipped in order for this to change from green to red. The next one is moving average, which starts to tell the direction of, do we think it's going to go up or down? And it looks like now that one is tripped down. And then you have the MACD, which is a momentum indicator, which is overbought or oversold. And so now they're saying, hey, maybe we've gotten a little over our skis. So this is not the sky is falling, but it does start to, it's an indicator that technical analysis use to be able to determine where they think things are going to go. But I've listened to some economists of recent, and a lot of what, you shrug off the noise and everything that, we're coming into the last, 40 days until an election, and then we'll decide whose policies will end up in the White House. When you look at that, the economists are saying after we get through the period, the rest of this year, and even into next year, things should be good. Except I am going to share this now, although I was going to do it on the next screen. For those of you that do not know, and again, I'm not a gloom and doom or a sky is falling messenger. I believe that, be prepared. So I saw one of my friends post on Facebook, hey, go ahead and start stocking up on some things that you had maybe loaded up on during COVID. And I started thinking about it. I'm like, oh yeah, I saw something yesterday about all the ports on the East Coast from here, from Maine to Texas. The unions are this close, like Tuesday, going on strike. If that happens, right, and they go on strike, a lot of what we use for household items could very well go off the shelves, right? Most grocery stores, local, retail outlets, will keep about 2 weeks supply in inventory or available. So I would encourage you, I have no idea, but things that you typically use and are consumables, and if you ran out of them last time, go ahead, do yourself a favor and order some now. So just in case. something does happen, and and things like toilet paper or tissues or paper towels, things that that we use every day and we take for granted because hey, we just need more, we go get it until we can't. So I'm not talking about things that are luxury items. If you can't get a cell phone or a computer, it's an inconvenience, but it's not going to change your life. But if you can't wipe your butt, that becomes disheartening and it can change your attitude real quickly. Again, it's just a suggestion, observation on my point. I would encourage you to look at what you ran out of last time, and it's not going to go to waste. Load up on it. So now let's look at income assets, right? So bonds, right? And again, 1 month, if you look at 1 month, everything is just hovering, right around that 2% or below. And the best month was again US Treasuries, which typically is a sign people are gravitating towards safety. They have concerns. But I don't care about 1 month. What I look at is what is the whole year telling us. So treasuries now are just getting, they've just got pummeled this year because everybody thought, hey, I want to be in the market, things are recovering, things are better. But now we're starting to say, maybe not so fast, right? But if you look at the neon green, this is high yield muni bonds. So what does this tell me? So if you're in an income type design for your portfolio and we need revenue, typically it's 3 to 4% is what people shoot for. I know when I'm doing my models, 4% in retirement is what we're looking for. And if right now when you see the word high yield, even if it's municipal, it just means above average risk. And it does not mean that we cannot lose money. However, the Fed just lowered, right, last week, right, interest rates on notes or on bonds. So the borrowing costs of money. So that actually is beneficial for portfolios that have bond holdings, right? So that will start to have a beneficial effect for the valuation of the portfolio. However, if you're CDs at the bank, things that are tied to the bonds are going to be lower, or if you're on that income stream that bond portfolio was supposed to start to throw off, you will start to see that under pressure if interest rates stay depressed here in the near future. And the Fed is talking about to try and curtail inflation, several more cuts. So the market loves it from an equity side. Bond markets don't necessarily like it, but we have a green line on bonds, and that does make sense because again, bond valuations, the underlying portfolios, when they have an inverse relationship. So if bond rates or interest rates get cut, then the actual valuation or the par rates of the individual bonds increases. So it's making sense, but I'm trying to help you to put it into a perspective of practicality and utilization for your own specifics. Now, this is the chart that has me concerned. Sky is not falling, but it's ticking up. So, last month we were about 50, but we're back up to 61, 62 now. This is a recession probability analytic tool. It's a proprietary tool that came from Formula Folios, and then when Brookstone bought it, they acquired it. It has about 100 data points that they're looking at and just saying these are signs, signals that we're measuring. 50%, anything below, we think, hey, we have clear sailing ahead. Anything 50% or above, we're just saying, just be careful so you don't get caught. Right? Nobody wants to go through 2000 or 2008. I've been looking at some charts lately, and those periods of time are painful. But one of the things that I've come to understand is that as we age through life, and that as we turn around and say, hey, when I'm 40, when I'm 50, if the market corrects 20, 30, even 40%, it's not good. We don't like it. Nobody wants to lose money, but you probably have time for recovery. But if you're 55 or 60, 65, and you're approaching retirement and saying, that's it, we cannot afford to go backwards. We don't have the time to wait for it to come back because we need that money to live off of once we stop earning a paycheck. So it's really, really important to work with somebody that knows what they're doing. And remember, retirement is about income. And the more sources of guaranteed income that you can design into your portfolio, the better off you're going to be and the less worry you're going to have. So again, that's what we at Professional Planning Services do. It's what we specialize in. That's why we do this every month, because we're paying attention. And so as much as you may, a lot of folks, they do it themselves, and there's nothing wrong with that, right? You say, hey, I think I'm diversified, I'm making money. What's wrong? And it's not broke, so why fix it, right? So maybe working with an advisor that didn't make sense at the time. But when you transition, or I just had a call with a person not yesterday, the day before. And she's 61, still working, had remarried, and the gentleman was fine, 65, got pancreatic cancer and passed away in a very short time. And she's now looking, and she basically said, he did everything. I don't know anything. And that's where, again, we just want to throw that out as we can help. And that's a great segue for me to make this offer. I've never made this offer before. And, we're going to start touting it every year. October is financial planning month, right? So as financial planning, a lot of us say, oh, well, it's going to do it. I basically hop online, I'll do it myself, whatever. But to do a true portfolio analysis assessment, risk assessment, right? Normally I would charge $1,500 for somebody to give me all the documents that you see here, allow my financial planning team and our software and our tools and our experts to look at, review, and to come back to you with some points that are of concern, or at least to be pointed out to you. We are going to, for the month of October, at no cost to you, if you take all of these documents, drop them into my share file on my email, right? So Caitlin just put into our chat box there the PDF, which is our intake form for clients. So if you take that and you get us this data back, take your time, put it back, right? It's not a race. It's important because people will spend more time planning for a 2-week vacation than they ever will for the next 20, 30, 40 years of their life. So to get this kind of an offer from a professional to basically help you to make sense of all the things you have, even if you think that you're okay, right? You're like, oh, my 401k, or I have my guy look at it, and it doesn't hurt to get a second opinion. So take these statements, and what quite often happens, a lot of these custodians, they offer you the ability to look at your 401ks online, and then they turn around and it's a screenshot. It's not the screenshot that we want. It's actually download the PDF. They must by law allow you to get the most recent statement. That is so critically important because our back room, what we're going to do is we're going to go through and dissect it. And when we dissect it, we put that information back to you in a format that says you are here. This is what you currently have. Are you aware that A, that's what you have? Now that you understand what you have, you can start to ask yourself, and we'll ask the question, is that what you want in comparison? And quite often what we find, especially in this area where people are trying to catch up to retirement, they know they want to retire. Things are changing and they're taking more risks than they need or should be taking in comparison to what some other strategies are out there. So again, we're never going to pressure you, but it doesn't, take us up on our offer, allow us to help you. And then lastly, a key component, and you'll see the Social Security statement, this is a complex area. A lot of people think, oh no, it's got it. I know what I'm going to do. Your circumstances are different than your neighbors, than the person that you work next to, your coworker. So we're going to encourage you, right? If you want to come, we just sent out our mailing. These fill up quick, right? And once we're at capacity, if you have not been to a Social Security claiming workshop, you need to come. We're not selling anything, we're educating. And that's why Rutgers allows us to do this. So we're in the South building, which is, come early, right? We start at 9 o'clock promptly. But I don't know if you can see my mouse, but on the right side of that black car that's on the map there, that's where the building is. That's the room where we is. So if you park, you can either park over here where the dumpster is, or you can park in one of the lots and walk over, but give yourself about 5 minutes because some of the parking is a little bit, and I don't know what the weather's going to be that day. So, come early, come enjoy the information and let us help you to determine what may make sense for you and your family to make sure that the income that you're trying to figure out, your cash flow, your burn rate in retirement is optimized. So that's what we do. So again, hopefully all this stuff made sense to you today. We're going to go ahead and play our disclaimer. And again, for those of you on the call that have joined me, thank you. David, Tim, Hamant, Thomas, those of you I know, have a great day. Thank you for joining me. And if you need me, reach out.